Fundamental analysis is the foundation of smart crypto investing. Unlike traditional stocks, crypto analysis focuses on decentralized networks and protocols, not companies. The key is to ask, does this project solve a real problem in a unique, sustainable way? Dive into the white paper, understand the goals, technology, and tokenomics. Assess if the solution is viable and if the technology is robust and secure. Separate projects with real substance from those built on hype. The goal isn't to predict short-term price swings, but to build conviction in a project's long-term potential. Strong fundamentals help you stay rational during market volatility. Ultimately, you're not just speculating, you're investing in technology that could reshape industries. This foundational knowledge is your first step to building a resilient crypto investment strategy. To evaluate a cryptocurrency's fundamentals, start with its technology. Is the blockchain secure, scalable, and truly decentralized? Check the consensus mechanism and development activity. Active, transparent development signals a healthy project. Next, examine the use case. Does it solve a real, widespread problem? Assess the team's experience and the strength of the community. Both drive adoption and resilience. Tokenomics matter. Look at supply, distribution, and the token's utility within the network. Is the token inflationary or deflationary? Does it serve a real function, like paying fees or staking? Fair distribution and strong utility increase the chance of long-term value. Combining these factors helps you spot projects with genuine staying power. Solid fundamentals are the backbone of any successful crypto investment. Technical analysis helps you understand market behavior and time your trades. It's the study of price charts and trading volume to spot trends and patterns. The most common tool is the candlestick chart, which shows price movements over time. Patterns in these charts reveal market sentiment. Are buyers or sellers in control? Indicators like moving averages show trend direction, while the RSI highlights overbought or oversold conditions. No single indicator is perfect. The key is combining tools for a clearer picture. Technical analysis is about probabilities, not certainties. Use it to refine your entry and exit points, not to predict the future. A structured approach helps you manage risk in the fast-moving crypto market. Mastering technicals gives you an edge in timing, complementing your fundamental research. The best investors blend fundamental and technical analysis. Fundamentals tell you what to buy. Projects with real value and long-term potential. Technicals tell you when to buy, helping you avoid poor timing and maximize gains. For example, strong fundamentals might tempt you to buy immediately, but technicals can warn if the asset is in a downtrend. Wait for technical signals, like a trend reversal or breakout, before entering. Likewise, if your asset is overbought, technicals can signal when to take profits, even if you believe in the long-term vision. This combined approach balances conviction with discipline. It helps you avoid hype-driven mistakes and manage risk. Integrating both methods makes you a strategic, well-rounded crypto investor. Let's see this in action with Ethereum. Fundamentally, Ethereum leads in smart contracts and decentralized apps, with major upgrades like the merge boosting its value. But its price has seen long periods of decline and consolidation. A combined analyst waits for technical signals, like a base of support or a bullish RSI divergence, before buying in. The same applies to Chainlink, fundamentally strong, but often trading sideways. Watch for technical breakouts above resistance on high volume as a buy signal. This strategy means you invest in strong projects at the right time. You avoid buying tops and maximize your upside. Combining the what and the when creates a high probability investment thesis. That's how you use both analysis styles to succeed in crypto.